India is right in the middle of what you could call a recycling gold rush. The old way of dealing with waste, it's being replaced by this massive new industry, the circular economy. So today, let's unpack the story of one company, Gravita India, that's sitting right at the heart of this huge transformation.
And just to get a sense of the scale we're talking about, look at this number. By 2030, India's waste management market is set to be worth over $39 billion. Now, this isn't just about cleaning things up. It's a colossal business opportunity, and it's being driven by urbanization, new rules, and a completely new way of thinking about our resources.
So that's the big question, right? How exactly do you turn what we think of as trash into a multi-billion-dollar treasure? Well, the secret is all about transforming a system that's been, informal and pretty inefficient for decades into a structured, modern industry.
All right, let's start with the big picture. India is at a real inflection point. The old, often polluting way of handling waste is giving way to a new, incredibly valuable circular economy. And believe it or not, a single government policy is what's really lighting the fire for this whole gold rush. And this is it. This is the policy that's driving everything. Extended Producer Responsibility, or EPR. The idea is actually pretty simple, but it's so powerful. It legally forces manufacturers of things like car batteries or plastic packaging to take charge of collecting and recycling their own products. This one rule basically creates a pipeline, funneling a massive amount of scrap away from unregulated players and straight to formal recyclers.
So where's the money in all this? Well, it's really concentrated in a few key areas. You've got lead, which mostly comes from old car and industrial batteries. Then there's aluminum, where recycling saves an incredible 95% of the energy it'd need for new production. And then you have plastic, where these mandatory EPR targets are making the formal recycling market just explode. These three materials, they're the backbone of this whole new industry.
And that brings us to our main character in this story, Gravita India. Now, this is a company that's been in the recycling game for decades, but right now they're in the perfect position to capitalize on this huge regulatory and economic shift. They're a global leader in the organized recycling of lead and other metals. This slide really nails the change that Gravita represents. On one side, you have the old way, the informal sector, which was often polluting and super inefficient. On the other side, you've got the new way, the formal sector, where Gravita lives. It's clean, it's efficient, and it's all about recovering high-value materials. They are basically the solution to the problems of the old system.
So how are they doing it? Well, Gravita has this really unique strategy. They call it the start small and grow big model. Instead of building one giant centralized plant, they build a whole network of smaller decentralized facilities. And they place them strategically, really close to both the sources of scrap and their customers. This is absolutely crucial because it slashes their logistics costs, which, trust me, is a huge deal in a cost-sensitive industry like this. Okay, now we're getting to the core of their story. There are three specific things, three catalysts, that are set to just turbocharge Gravita's growth over the next few years. Let's break them down one by one. The first engine is a direct result of that EPR policy we were just talking about. Because the government is enforcing it more strictly, it has led to a massive 60% surge in the amount of scrap Gravita can get from right here inside India. This is a total game changer. It secures their supply of raw materials, means they don't have to rely on imports as much, and makes their profit margins a lot more predictable.
Engine number two is just pure ambition. Gravita is right in the middle of a massive expansion. We're talking an investment of over 6 billion rupees to more than double its total recycling capacity by 2027. This isn't just about getting bigger, it's about scaling up to meet the enormous demand that this formalization of the industry is creating.
And the third engine is a really smart strategic pivot. See, historically, Gravitan has been all about lead recycling, but their vision for the future is all about diversification. By 2029, they want 30% of their revenue to come from non-lead segments. Why? Simple, because these other materials like aluminum and plastic often come with much higher profit margins.
And here's what that diversification actually looks like in practice. They are pushing hard into aluminum and plastic, which are growing at just phenomenal rates. But they're also looking ahead, with a pilot project for lithium-ion battery recycling set to start soon, and they even have plans for steel and paper down the line. This is all about moving into businesses that are growing faster and are more profitable. Of course, no growth story is ever a straight line up, right? To get a really balanced view, we have to look at the potential risks that could slow Gravitar down, and there are three key ones to keep on the radar.
First, at the end of the day, this is still a commodities business. The prices of lead and aluminum can swing pretty wildly on the global markets. So if the price of scrap they buy goes up, but the price of the finished metal they sell goes down, their profit margins can get seriously squeezed. Now, they use hedging to manage this, but it's an inherent risk they're constantly navigating.
Second, there's what we call execution risk. That massive 6 billion rupee expansion plan is fantastic on paper, but they have to actually build and get these new facilities running on time and on budget. Any big delays could directly impact their ability to hit those ambitious growth targets they've set.
And finally, their biggest advantage, that EPR regulation, well, it could also be a risk. If the enforcement of these rules weakens for some reason, the informal sector could creep back in and disrupt their supply of raw materials. On top of that, they face some stiff competition from other formal players like Pondy Oxides, who are also expanding aggressively.
So with all those risks in mind, how is the market actually looking at this company? This is where it gets really interesting. Investors are starting to see Gravita not just as some cyclical metals processor, but as a long-term structural growth story. This table shows you exactly what that news story means. It's a concept called re-rating. Just look at the valuation. Historically, investors paid about 12.5 times the company's earnings to own its stock. Today, they're paying over 35 times that. The market is paying a huge premium because it believes Gravitas's future is fundamentally better and more reliable than its past.
So the crucial point is this: Gravitas has transformed. These strict new environmental rules, especially EPR, have basically handed them a sustainable competitive advantage by locking in their raw material supply. This has shifted them from being just another company riding the crazy ups and downs of commodity cycles to being a structural beneficiary of India's massive push towards a circular economy.
And that leaves us with a final thought to chew on. The Gravita story is such a powerful example of how a change in rules can completely reshape an industry and create incredible value. It really makes you wonder, as new regulations continue to rewrite the playbook for old industries, from energy to manufacturing, where is the next hidden opportunity just waiting to emerge?